From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Farrow. These equity markets are selling the facts all the way around. The Woodstock of AI has Nvidia lower this morning. It's just a hint of a lack of belief in tech. Can it carry through to the upper ground? Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up in the show, futures move lower as the central bank extravaganza gets underway. The Bank of Japan puts an end to negative rates with the focus turning now to the Fed. And Nvidia shares under pressure, as I said. The AI Woodstock delivers few surprises. We begin with the big issue, global central banks getting to work.
It does feel like we are now in a new era, and maybe this time is different for Japan. And also when it comes to investing in the economy's markets as well, the meeting in and of just by itself isn't quite a game changer in the sense that, one, it was very well telegraphed, which I think is flowing through into some of the market moves that we're seeing. And also, even though we've seen that rate hike, we are seeing a lot of accommodative leanings within some of the other details.
It is a host of monetary policy decisions still to come this week, including the Fed tomorrow. Let's get our team coverage underway. Enda Karen and Michael McKee join me. Enda, to you first of all. The Bank of Japan ripped off the Band-Aid. They've thrown off YCC, and they've raised rates for the first time in 17 years. So this is a significant move, but the markets are not reacting to the scale of the move, are they?
No, they're not. It was a 7-2 vote. I think the big takeaway was that the Bank of Japan weren't necessarily in a hurry to signal another rate anytime soon. They were careful in the language. Governor Ueda made the point that overall policy settings are still supporting the economy, so he wasn't signalling any kind of a rate hiking cycle like we've seen in Europe or the US. He did say, though, that if wage gains do continue, they're going to keep a close eye on that, hinting perhaps that the Fed or the BOJ does have some options up its sleeve to maybe tighten again later in the year. But I think all told, the BOJ will be happy with the outcome. The yen coming off a touch is nice for their exporters. They didn't want to set the yen on fire, of course, which would have caused more pain for the economy. So they've pulled out of ETF buying. They've pulled out of negative rate territory. They've scrapped the YCC without blowing up the markets. I'd say the BOJ are probably feeling confident that it's a job well done, at least for this part of their policy programme.
Yep, certainly the markets have reacted judiciously for now. And thank you very much. Mike McKee joins me. We are in the middle of the conversations about what comes from the Fed. And of course, the market has begun to reprice. It's now toying costs for a rate, let's say, moving from 3 to 2 cuts beginning in June. Mike.
Well, I wish I could promise as much excitement as Enda got with the Bank of Japan, but the Fed may not provide it. There is a question about whether they would change the dot plot, but the general expectation is they stay with 3 rate cuts this year, because if they don't, it will send quite a signal to the markets, and we wouldn't have the kind of reaction that we've had from the Japanese markets. There is also a widespread belief that they're going to raise their inflation forecasts. They will have a discussion, but no decision on when and how they're going to start tapering their balance sheet QT. What you don't expect from them, of course, is a rate move. They're not going to do that this time. And they're not going to give us any guidance on rate timing, which is what really would make people on Wall Street happy. The interesting debate, which we probably won't find out more about until either the news conference or maybe the minutes, is do they think the bigger risk is a slowdown in the economy or sticky inflation? The economy has started to show signs of slowing. The City Surprise Index heading downhill, not suggesting that there's a lot of residual strength here yet. And then when you take a look at inflation measures, there's been a big surprise over the last 2 months. We have seen inflation, CPI, PPI, PCE, all rising the past 2 months. Does that indicate that there is something wrong with what the Fed is doing, or are these areas that the Fed doesn't seem to be able to touch with their monetary policy? That's going to be a question for Jay Powell as well. So a lot to think about, and we don't know whether we'll get any kind of market surprise or not.
Okay, let's see where those dots go. I think that's where the real focus is. Enda, thank you very much, Enda Karen, Mike McKee, for the update. Kit Jukes wrote this morning after the Bank of Japan. Deflation is over, real wages are rising, and maybe the equity market appreciates the long-term implications in a way that the FX market does not. So let's pursue that conversation. We've got Aoifinn Devitt of Moneta and Vishwanath Tirupattur with me from Morgan Stanley. Good to have you with us. Let's just kick off with the Bank of Japan, because they seem to have sort of driven by this market unscathed at the moment. Would you agree, Aoifinn, that this has been a sort of a move where the FX market has just shrugged its shoulders, it's sold the fact, so to speak, but the equity markets are still quite optimistic in Japan?
The land of the rising sun is really only rising right now. There has been such extraordinary strength in that market, a lot of it quite divorced from fundamentals. When you look at the average age, there are some of the demographic challenges and really some of the hope that's built into this so-called better, more friendly shareholder environment there. So there is a lot of head scratching, I think, around the strength in Japan. No surprise that they did skate by this rate move, as it was long forecast, and in fact very modest and very much a sign of health. And again, with the weaker yen, that is, of course, another source of strength for the economy there. So I'd say no real surprise. What is a bit of a surprise is, I think, how resilient the equity market has been. That is extremely frothy, these 40-year highs. Again, why isn't this being affected by the same fundamentals that seem to be affecting China for similar reasons?
Yeah, I mean, as you say, it's perhaps divorced from fundamentals. It's reminiscent of bubbles, and we'll come back to that in a moment. That was in the late 80s. Vishy, good morning to you. You talk about the tailwinds that the financials will have in Japan, and this is critically important, isn't it? We move into positive rates, and the banks and institutions will begin to earn on some of their reserves.
Absolutely, and good morning, Manus. I think the wage hikes that we've seen coming through last year and what we are already seeing this year would really strengthen the conviction we already have in the earnings improvement. I think, as our equity strategists have been highlighting this point for some time now, that this earnings improvement in the domestic companies in Japan is a very meaningful thing. And this is particularly for financials, as you said, moving into positive territory is a significant tailwind. So we could, I think this is none of us are really surprised that either the JGBs or the JPY, the FX or the rates markets really had any big moves on the back of this, because this was a widely and very well telegraphed, and there was really no surprise that it happened last night. There was so I didn't really expect much to happen, and in terms of the market reaction in the macro markets, and nothing did happen.
Listen, before we pivot to the Fed, Aoifinn, I want to just pick up on your point. You talk about a divorce from reality. You've reflected on bubbles and the nature of bubbles. I look at the Nikkei, up 19% year to date, 39% in the past 12 months, outperforming the US. Do you think that there is a hallmark of stretched euphoria in Japan relative to the rest of the world, specifically the US?
That's a really good question. I'm not sure it's relative to the US. It certainly is relative to China and other regions. There is a lot of euphoria in the US too. I think the question there is whether there's a bubble more broadly, or whether it's really just within AI, or whether there's a bubble at all. There's no doubt that momentum rules the day right now. And I suggest that in Asia, momentum is ruling the day in Japan as well, because there's simply nowhere else to go. There's too much hair on some of the other areas. And then within emerging markets, there's a lot of very toppy valuations as well. But good question.
It's interesting that in the Bank of America Fund Managers Survey, the pivot, the exposure, the delivery to exposure to emerging markets is the highest in 5-6 years. So there seems to be a reaching for breadth. Let's talk about what could disrupt risk, and I'm curious to get your take. Let's talk about the Fed. There is this sort of momentum behind the conversation that we're going to move from 3 dots to 2 dots. I've never been so excited or nauseated in my life, but to what extent would a move from 3 dots to 2 dots the indication of a slower path to cutting? How disruptive would that be to equity and overall risk? Aoifinn?
I don't see a big risk to that. I think that's already been discounted in. I think there will, of course, be that parsing of words that the Fed uses. And if there's any more negativity in the words, if there's a reference to stickiness of inflation, I think that's going to be more triggering than the actual dot plot itself. Now, where is the risk? Yes, that this momentum algorithm goes wrong all of a sudden, and we do see risk off. We're also seeing this rising oil price right now, whether that's going to start to be a problem for inflation. So I think it's more about the words than the dots right now.
Vishy, I mean, I was reading Steve Englander's research before it came up, and it said if the dots were to move, it would softly acknowledge the slower disinflation shift. But they need to stress the willingness to cut if it shows that inflation has continued to drop. So are you not as bothered as Aoifinn is if we move from 3 to 2?
I wouldn't say I'm not bothered from 3 to 2. I think the market will interpret the move from 3 to 2 as a hawkish signal coming from the market. I think it's a lot really depends on how this, if there were to be a change, and how this change is messaged both in the statement as well as in the press conference. That will be really critical.
Okay.
So
if they go from 3 to 2, Vishy, what does the bond market do? Because, again, people are now writing notes about 4.32 is critically important to the equity market. So if they move from 3, indicating 3 cuts to 2 cuts and muted language, what would that do to the yield market?
I think it's a combination. I think that they're going from 3 to 2 cuts and a messaging that's more hawkish. If the messaging signaling is more hawkish, and we could see, a 10-ish basis point moves in the long end of the curve, that we could definitely see that.
Aoifinn, let's just square off finally. The balance sheet has quietly driven by as well, hasn't it? It's gone from 9 trillion to 7.5 trillion, and we remain unscathed. How important is it for markets and liquidity that they slow the pace of the runoff? Briefly.
And certainly, with no shocks is what markets want right now. Markets want slow and steady, as was mentioned by your other guest, well-telegraphed move. That has been the order of the game. No surprises. Nobody wants to inject that kind of volatility. So yes, nothing drastic. I think what will have to be the name of the game. And as we can see, though, markets are more focused on corporate earnings and corporate rhetoric than they are on some of these macro indicators, unless it's the strong growth and the low unemployment that we've been taking a lot of comfort from. So I'd say, yes, nothing too surprising, I think, is the order of the day. OK,
well, we'll dig into the corporates in just a moment when we dig into Nvidia, the daily check. Aoifinn, thank you very much. Aoifinn Devitt and Vishwanath Tirupattur stay with me to talk through the markets. Let's go under the hood of the belt. You've got Nvidia dipping. We'll dig into that story in just a moment. The AI event kicking off in San Jose, unveiling their latest and greatest chips.
The computer is the single most important instrument of society today. Fundamental transformations in computing affects every industry.
AI Woodstock failing to impress the street the morning after the night before. Will day 2 deliver any surprises? We discuss on Bloomberg.
The industry is being transformed, not just ours. Because the computer industry, the computer is the single most important instrument of society today. Fundamental transformations in computing affects every industry.
Nvidia launching its much-anticipated AI event in San Jose. Unveiling the latest processor design, it's called Blackwell, and introducing new technology aimed at extending its AI dominance. Day 1 failed to impress the street. If you look at the stock price pre-market, we're down just under 2%. Few surprises. Is that the correct assumption and take? Mandeep Singh is with Bloomberg Intelligence. I mean, it's almost like an Apple event now, isn't it? Where he held up the sort of the predecessor to Blackwell, saying to the market, this is the future. Define what is it that Nvidia are going to offer us in Blackwell?
Yeah, I mean, when you compare Blackwell to Ampere and Hopper, their prior architecture, This one is focused towards Gen AI training and inferencing. The last, two architectures were GPUs, which were used for AI training. But I think what they have done is really gone big in terms of customizing the chips for performing, for training and inferencing workloads. And the performance, 4 or 5 times their Hopper kind of release just shows how quickly the product cycle is accelerating for a company like Nvidia. So the competitors, will find it hard to catch up in terms of performance. And we're talking about AMD and Intel. Yes, AMD has MI300, but I think Nvidia is far ahead in terms of the performance that they can get with their chips.
And this is something you and I touched on a little bit earlier. I was sitting in the surveillance studio and you were there and you were saying, look, what is more concerning is perhaps the poor man's Nvidia, or the poor woman's Nvidia is falling further and further behind. How big is that gap? And in terms of cornering the market and market share for AI, if you look at Nvidia relative to its peers?
Yeah, so what Nvidia seems to be doing really well here is they are moving up the stack. They're not just providing you the chip, they're also providing you the networking. And there seems to be a lot of focus on the networking aspects, especially at the GTC. And, I find them releasing even microservices that competes with hyperscalers. So at the end of the day, they want to develop an ecosystem. Almost every large tech company announced a partnership with Nvidia at the GTC. That just goes to show the power of the ecosystem they have built, and it'll be very hard for other companies to replicate that given the lead they have, on the product side.
I think it's interesting how the overall market obviously is at the mercy of Mag 7, and we are at the mercy of a mindset when we check Nvidia price down 2%, 2.5%. The whole market seems to suffer. There's the performance over the past 3 months, which I think puts a better context around it. But we've also got this sort of mania out there. We've got YOLO traders, I think it is, betting that the stock could double by Friday, $1,940 calls. Now, look, that's a small trade with an extreme headline on it. But given the speed with which Nvidia has grown in value, are these ludicrous kind of calls for a doubling in value? Moore's Law, it does not run forever.
And look, I think that's where expectations will get ahead of themselves. The fundamentals still look very strong to me. But, the CapEx cycle, the way we have seen it historically, is the above trend CapEx will catch up, will slow down eventually because these companies are spending way too much compared to their historical levels, especially the hyperscalers. And given the concentration, they're all trying to develop their own chips. So even though Nvidia has the lead, somebody will come up with an architecture that can mimic the performance, and the cost-benefit analysis will come into play at some point. So I do think that CapEx slowdown is a big risk for Nvidia, and that's where valuations will matter. You just can't keep paying up for buying the stock here.
Okay, Mandeep, thank you so much. Mandeep Singh of Bloomberg Intelligence. Aoifinn Devitt is with me and says this: there is a convincing analysis comparing the current surge in chip makers to other infrastructure-led cycles. But the question remains as to whether the current euphoria has gone ahead of itself. Aoifinn, very simple question. You see a small drawdown today. I wouldn't call it anything to worry about. It's just a market which is reflective and it's selling the fact. But can this euphoria endure? I know you've done some work around bubbles. You've reflected on it. How much of Nvidia is a manifestation of a mania or a bubble?
I'm going to say actually a much smaller percentage than we might think. I would actually maybe argue with your previous guest in that some of the spending perhaps is only getting started. What we can see is that there's something front and center of many minds is not being left behind. Just as FOMO is an issue for investors, it's an issue for companies too. And they know that even saying they're spending on AI gives them a boost to their valuations. So I'd actually suggest that we're only scratching the surface here. We've moved beyond the training stage and we're now into the stage of integrating how this matters. So we have to always raise the question as to whether it's ahead of itself in the moment and that perhaps there's a little bit of froth relating to that momentum I mentioned before. But in terms of more spending, I see a lot more spending on this, on cybersecurity, on everything where the cracks can appear in our new cyber existence.
Yep, it is one of those paradigm shifts. Let's take it to the bond and credit guest. It's always an interesting conundrum to speak to a bond and credit investor when you see euphoria in equity markets. But here, the argument is this, is that 432 on 10-year paper was supposed to be an inflection point for the equity market. Could I spin it around, and this is what they were doing on surveillance this morning, which is when does the bond market catch up with the equity market?
Well, I think there are several threads you could go there in that context, what you just said. I think what's happening really is from the technology and innovation perspective, I think what we see this year as a year of this innovation moves into a broader diffusion, and that should result in some productivity gains. How quickly those productivity gains would be realized is still unclear, but I think we are looking for productivity gains to come that accrue to the two companies. From a credit perspective, and Nvidia is a AA, is A+, highly rated company with not a tremendous amount of debt outstanding, and the trade's pretty tight. So not surprisingly, you will not have seen much reaction in the credit markets for this.
Okay. Well, let's see. Aoifinn, as you say, we're in the foothills of perhaps a new paradigm shift in technology and AI. Aoifinn Devitt and Vishwanath Tirupattur, my guests this morning on the markets. Coming up, your morning calls, Bank of America's Fund Managers Survey, something for everybody, shows risk appetite hitting the highest level since 2021. More on that conversation with Elyas Galou joining me shortly at the opening bell, right here on Bloomberg. Your morning calls. What are the analysts saying on Wall Street? First up, Barclays upgrades 3M to overweight, highlighting the compelling valuation, the positive catalysts on the horizon. Next up, Redburn downgrades Snowflake to a sell, expecting little upside due to the limited AI products. And finally, Stevens raising a recommendation on Trust Financial to overweight, raising the price target to $43. Analyst notes there is an opportunity to increase on the earnings per share on Trust Financial as opposed to Trust Financial. Coming up in the show, we're going to take a deeper dive into the Bank of America Fund Managers Survey in terms of the sentiment, their risk appetite, the highest since November 2021. And there is a reach to emerging markets. Bank of America Survey in focus next on Bloomberg. Bit of a drag on these markets this morning. Nvidia and the other chip makers all just taking a little bit of a heat out of the market. The AI, the Woodstock for AI, was slightly underwhelming. Our last guest, although, said we are in the foothills of a technology revolution. Can Nvidia, however, continue to propel higher at the same kind of velocity? For right now, we're down by 1/8 of 1%. Nasdaq futures lead us lower by 1/2 of 1%. And the debate for the Russell 2000 is to what scale will the dots be scaled back from 3 rate cuts indicated to 2 potentially. Across the rest of the assets, dollar-yen down for, well, this is dollar up and yen down for the 6th day in the row. The Bank of Japan finally raises rates, their first hike in 17 years. There's a split to the Bank of Japan, hence the reason why the market is unsure that you're in a new cycle of rate hiking in Japan. Bitcoin is down by 5.58%. There was a massive outflow yesterday from Grayscale. The ETF posted its biggest daily outflow, I should say, on March the 18th, $643 million. So a little bit of dislocation in the flows from not just Grayscale, but other ETFs as well. Yields dropped by 1 basis point. Nothing to write home there. We are in the midst of counting down to the Fed. What will the dots give us, and what will the conversation be from Jay Powell? One stock to watch, as I say, it is Nvidia, kicking off its AI conference with a new processing chip named Blackwell, failing to deliver any big surprises. Has that left investors wanting more for day 2? Ed Ludlow is with me. Blackwell has underwhelmed for now.
Yeah, I don't know that the performance of Blackwell, or on paper what Blackwell's capable of, is underperforming. It's very much a sell the news kind of event. We got everything that the street expected, but also hoped for. And a number of analysts on the sell side, at least, are looking at the relative performance of Blackwell to the prior generation Hopper, or as we know it, H100. So 2.5 times performance on the training side, 5 times on inference side. And when clustered, the Blackwell has 25 times power efficiency. And as we scale up the infrastructure on the data center side that relates to the AI build out, power is a really big consideration. The board on your screen is really interesting because if there is a feel good, it is all of the end user customers that Jensen Huang name checked on stage. In particular, Dell up a percentage point. And what Huang said, the Nvidia CEO, is that there is no one better at building out that full server system than Dell. We knew this was coming. The question is how quickly Nvidia can ramp and scale output. They did that incredibly quickly with H100. Blackwell starts shipping at the end of this year. And if you look at whatever function you use on the Bloomberg terminal, EEO or MODL, the expectation is that in the coming fiscal year, we see a continuation in the surge of that data center revenue for Nvidia. I'd also point to some of the other things. We've got some evidence that Nvidia is now starting to monetize its software offering, which is something that the street was looking at closely. But I'll be heading to GTC straight after my show, Manus. I'm told by those on the ground it is living up to the name of Woodstock for AI, but I'll report back to you tomorrow.
Very good. Identify those boomers, Ed. They sort of look a little bit older than me. Ed, I'll leave that with you. Ed Ludlow chasing the great prize that is AI at the conference. Let's turn to the consumer space. Beyond Meat is filing a $250 million mixed security shelf registration. Abigail Doolittle has the Doolittles. Please explain what that is.
I absolutely will. But first, let's stick with chips, because Beyond Meat is not the only company out there with a public offering. I'm talking about Super Microcomputers. They make servers that are stuffed with some of those Nvidia AI chips. That's part of the reason that over the last year, this stock up about 1,200% at the peak. Since then, it has given some of those gains back into yesterday when it was added to the S&P 500, down a little bit, and now today down 8.6% on their plan to sell 2 million shares. And of course, that has everything to do with the possibility of dilution. It will bring dilution, so investors don't like that. One thing to point out, though, here, Super Microcomputer, unlike Beyond Meat, highly profitable. Last year, they put up $12.79 per share in adjusted earnings. When we turn to Beyond Meat, what they have done, they filed a $250 million, so much smaller, mixed security shelf registration that could include stocks, bonds, preferred warrants. We don't know. And it does not mean that the sale will begin, and it doesn't mean that it will ever happen. But in this case, because Beyond Meat is deeply, deeply unprofitable, last year posting a loss of $4.93, if any of those securities, if they do sell securities and they happen to be on the equity side, it could really dilute and make a loss even deeper on a stock, unlike SMCI, down 45% over the last year.
Okay, Abby, thank you very much. Let's dig a little bit deeper into the crypto story. We checked the price of Bitcoin as we started this session. Stocks linked to the digital asset slipping. Grayscale ETF posting the biggest daily outflow. Simone is with me. Simone, it's been a bruising 2 days for Bitcoin. Just beef up those details for me.
Yeah, well, the Grayscale Bitcoin Trust lost $643 million in terms of outflows yesterday. That's the most of any day since it turned into an ETF on January 11th. Now, that in and of itself is not so surprising because GBTC has been seeing outflows pretty consistently since then. But what may be more surprising is that the inflows into other ETFs in this space, the other 10 ETFs, are not making up for it as they had been for the past 2 months. In fact, of those other 10 ETFs, we saw net outflows of $154 million. That's what's sending Bitcoin to its lowest level in 2 weeks. That's what's hitting those other crypto-linked stocks, especially ones like MicroStrategy, which announced this morning that it had actually paid more than $600 million to buy over 9,000 Bitcoins. You look at Marathon Digital Holdings, you look at Coinbase, all of those stocks taking the heat this morning. Now, crypto trading firm QCP Capital, they're out of Singapore, saying they will be closely tracking the aggregate ETF flow numbers today because a net negative would be a distinctly bearish signal. All of that being reflected so far today in the price of Bitcoin, now down to, it looks like, $63,600, as well as all these crypto-linked stocks, Manus.
Okay. Certainly a lot of angst in crypto land. Simone Foxman there. Bank of America's latest fund manager survey has been released, and the investors are going global, from US tech to Europe and EM. Katie Greifeld has the breadth and reach of this survey. Katie.
Well, Manus, it was pretty bullish across the board and across the globe. Let's go through some of the size and scopes here right now. Risk appetite was at its highest since November 2021, which makes sense when you take a look at global growth expectations, highest since January 2022. Going down the list, the allocation to stocks was the highest since February 2022. And what gets interesting here is that we're not just talking about U.S. equities. You take a look at the allocation to EU and EM stocks, that is the highest since May 2023, with the poll showing really a big rotation into Europe, EM, and financials, interestingly. So again, it's not just about these U.S. stock markets here, but let's get into the crowded trades. This was a really interesting section, and it's, as you would expect, the long Magnificent Seven trade was quite crowded at this juncture. Short Chinese equities, that also makes sense, but long Japanese equities, long Bitcoin, and long cash. That is very interesting, Manus. Of course, with all this bullishness on equities, on risk assets, you still have the average cash level ticks up to 4.4% from 4.2% of AUM, and you have strategist Michael Hartnett writing that that cash level measure, once it gets to about 5%, that's a buy signal.
Okay, there's a lot to chew on there, Katie. Thank you very much, Katie Greifeld, with the latest from Bank of America. Joining me now is Elyas Galou to discuss some of these findings. Good to have you with us. I mean, I was listening to Candace Browning this morning. This is very much a reach for global return would be one of the top takeaways here. I mean, global growth expectations are at a 2-year high. Equity allocations are at a 2-year high. But there is a real reach here for beyond the US.
Hi, Manus. It's great to be here. Thank you very much. Yes, if I had to actually summarize the big takeaway from this month's Global Fund Manager Survey, it would be optimism. We saw optimism across the different metrics we typically look at. As you just said, global growth expectations are the highest in the past 2 years. Profit expectations are the most optimistic in the past 2 years. Stock allocation at a 2-year high. And more importantly, this optimism is now seen in the risk appetite, which is the highest since November 2021. So investors are bullish about the macro. Investors are more confident that the economy will avoid a recession. And what do investors buy when they are confident about the macro and the markets? They buy international equities. We recorded the largest pivot into Eurozone equities since June 2020, the largest pivot into EM equities since April 2017. And on the other side, in terms of sector, they also buy financials. That's why we saw a big rotation into banks.
And still, day to day, we talk about how stretched the concentration is within the Magnificent Seven, within technology. And I was drawn to the bubble question in terms of AI being in a bubble. This is a split. The market is very, very closely split here. 45% say no and 40% say yes. So this is, how is that evolving, or how has that evolved?
This is a question that we actually asked in the past, and about a year ago, investors were not thinking that AI was a bubble, and now, as you said, the split is very close, but still, investors believe in AI structurally. They believe that the current valuation of the Magnificent Seven, of any AI proxy, is not bubbly, and I would say it also adds to the element of confidence. You have a big conviction that the global economy is headed towards a soft landing. 62% say that the economy will experience a soft landing. About 2/3 believe that there will not be any recession. You have also a big conviction that rates will be lower, both short-term and long-term rates will be lower. If you add to that this expectation and this belief that AI is not in a bubble, there is no risk of a bubble, I think that's a very powerful cocktail for confidence, and that's what we see in the data.
It's interesting, a year ago I was in Zurich reporting on the demise of Credit Suisse, the birth of one of the biggest new systemically important banks, which is UBS, worth over 100 billion now. And then we were talking about regional bank failures here in the United States of America. Do you think that we've gone past the worst of those fears from systemic risk at the UBS Credit Suisse level and the regional bank level here in the United States?
When we typically ask our FMS participants what they think is the most likely sort of a global systemic credit event, and this month it was US commercial real estate. In the past year, that question has been mostly focused about the commercial real estate and the real estate. In US, it's commercial. In China, it's the property sector as a whole. But investors are still worried about commercial real estate, less about banks, because, again, they believe that rates will be lower in 12 months' time, and that's good for the financial system.
And US equities still remain top billing. I mean, we're talking about the globality of this fund manager survey, the reach into EM, as you said, one of the biggest pivots since 2017. But still, in terms of the United States, are there any idiosyncrasies, any selling going on at these upper levels, at these records that we've been putting in the first quarter?
Of course. Well, in fact, last week we just recorded the biggest inflow ever into US equities. So valuation here are not a particular problem for investors. But just focusing on the fund manager survey, when you look at the allocation across the different assets, you still see a very significant and notable overweight regarding US equities. But this time, because investors are more bullish about the global growth prospect and about the profit growth prospect, they pivoted away from what they like, as in US equities, and whatever is big in terms of US equities, tech, healthcare, growth in general, and they bought international equities, which they see as less overvalued and with good growth prospects.
Elyas, thank you so much. Great context around the survey.
Pleasure.
Elyas Galou from Bank of America. Let's get across to Abigail Doolittle. A little bit of breaking news on the retail side from Nordstrom. What have we got, Abby?
Yeah, we have the shares of Nordstrom spiking right now up about 11%, heading to the best day in more than a year, on the headline that the Nordstrom founding family seeks to take the company private. This according to Reuters. They did, of course, try to do this unsuccessfully about 6 years ago. The largest shareholder is Bruce Nordstrom, owning about 15.5% of the public float. According to another source, Nordstrom has asked both Morgan Stanley and Centerview to reach out to private equity firms and gauge their interest for a potential deal. But again, we do have the headline that Nordstrom's founding family is seeking to take the company private, and the stock is soaring up 11% on this news, Manus.
It is pumping up higher. Abby, thank you very much. Coming up in the show, 1 year since the fall of Credit Suisse.
There hasn't been the kind of change there was last year, because there are unique business models. That's what's not involved. A little bit of it, and so nothing we're seeing. And by the way, we see a lot of flows, and we don't see it anywhere.
We'll dig into banking next on Bloomberg.
There hasn't been the kind of change there was last year, because there are unique business models. That's what's not involved. A little bit of it, and so nothing we're seeing. And by the way, we see a lot of flows, and we don't see it anywhere. The industry is well capitalized, has good liquidity. Believe me, from last year to this year, people short up their liquidity across the industry.
Well, today the markets mark 1 year since UBS took over Credit Suisse, its rival. The deal has pushed UBS's market cap past $100 billion to the highest level in almost 16 years. Sonali Basak joins me now. A year ago, I was standing on a rooftop in Zurich, and we were talking about whether this was an amazing steal for Motti and Kelleher, the team that put this deal together. And it is. I mean, it's triumphant. The amount of assets they manage now is $5.7 trillion. The stock's worth $100 billion. What's gone right so far?
Yeah, it's interesting. You even have JP Morgan analysts saying that they have a better business mix than Morgan Stanley. Remember, Morgan Stanley doesn't have as large of an international wealth manager, and that's obviously a massive opportunity for UBS as they continue to gain share under this combined wealth and asset manager. Now, the big question marks remain profitability and improving those margins. You may remember, even before the deal had happened, that UBS and its presence in the Americas in particular, and the cost of building that wealth manager out, has always been a massive focus. And you have UBS Chair Colm Kelleher even pointing to the fact that this year will be a year where a lot of investment is needed.
But then how do they grapple with that? Because the cost ratio here in the United States is higher. The model here is fundamentally different to the wealth management model in Europe and the Middle East. So how do they grapple with that? How do they grow market share here? We had Ralph Hammers, some would say it was an ill-fated robo-advisor deal that he tried to put together here, which was cast aside. How do they grow? How do they compete? How do they get the valuation that Kelleher wants against Morgan Stanley?
This is the
that's the holy grail for him, isn't it?
It's the million-dollar question, and you've got to say in some ways he's kind of lucky because Morgan Stanley is going through a transition of their own when you think about the CEO transition and what is happening there. If you look at the stock this year, you have actually UBS up, whereas Morgan Stanley is a little bit down on the year still in the middle of all this. Now, again, they are still tens of billions of dollars away in market cap, but you do see an interesting dynamic here. Remember, you did have UBS CEO Sergio Armati saying that he would sacrifice top-line growth here to improve profitability and grow reasonably. For Sergio Armati, you know this more than anybody, that it's always been not just about growing the top line, but making sure that the profit makes sense. And we're not just talking about the wealth manager here anymore. We're also talking about investment banking. And you can say that they've already hired this massive team from Barclays and elsewhere where they're repositioning to gain more share at a time where we know it's been tough. Deals are just coming back. Competition is hot, but they do have a new team in place.
Yeah, I mean, he is laser focused on return on equity, and it has always been his mantra. Very briefly, we're in bonus season. Where are we on the payouts this year relative to last year? A little bit slimmer?
A little bit slimmer last year, but the hope is that it'll come back this year. And remember, the reason that the New York City Comptroller keeps such a close eye on this, Manus, is because, of course, this goes back into the money that goes back into the city. And so there is a hope that this will increase. Actually, headcount did increase Wall Street wide. And so that is a little bit of a perk to show you that perhaps the banks are preparing for a brighter future.
Okay, just depends which bank you're at and whether you're in the lowest performing quartile. Sonali, thank you very much. We'll see a little bit more Sonali later in the day. Coming up, we'll get into the sector price action for the morning. Abby, what have we got?
It's very interesting this morning, Manus, because we have a decline for the S&P 500 right now of about 1/4%, but most sectors, interestingly, are higher. So let's talk about those first. Utilities, that is one of the defensive sectors. We have yields down, so the dividends of that sector look more attractive. Energy higher as oil climbs just a little bit. To the downside, it's all about the mega cap tech sectors, both communication services. We have Meta, Alphabet, Netflix, Disney, AT&T down. We also have technology down about 0.8%, and I don't need to tell you that has everything to do with the chips. In fact, let's take a look at the chips, because over the last 5 days, we do have the stocks down nearly 6%, or maybe more than so. Yeah, almost 7% at this point. This, of course, is Nvidia and is dragging, but also taking a sympathy trade with some of the other chip companies, such as AMD. And that is one reason why we have the S&P 500 Tech Index down 2.8%. That was the index that put in the first record high last year, Manus. Let's see whether or not it's now telling us that we're seeing some kind of inflection point to the downside, at least in the near term.
Okay, Abby, thank you very much. Coming up, we'll give you market-moving events that you need to keep a note of in your trading diary. They're nervous in these equity markets. Day 2 of the AI Woodstock with Nvidia today. Let's see what they say there. But there is a nervousness. The Nasdaq is down. Nvidia is lower. We're just seeing some of these chip markets under a bit of pressure. Keep your eye on Nordstrom belting higher, up by 12%. Will the company go private? The bid is now being worked on. We understand some of the bankers have been discussed with. We'll leave you with that view of the red on the markets at the moment. Nasdaq down 0.75%. This is what you need to know for the rest of your trading day. Wednesday, we get the Fed decision, Chair Powell and his news conference. Thursday, it is the Bank of England. Plus, stateside, we get another round of US jobless claims and PMIs. Finally, Friday, we get the Atlanta Fed President Raphael Bostic kicking in to Fed speak. That was countdown to the Open. Surveillance was on tour. We're all back in the house of Bloomberg tomorrow, and we'll do it all again.